Great to have you back on the show. Given the fact that we have seen interest rates start to move higher, we do have a Fed that is beginning to tighten. I realize we're coming off of really historical lows where rates are concerned, but nonetheless starting to affect mortgage activity, at least. Rising rates, is this a headwind or a tailwind for Invitation Homes?
Well, you certainly would think at the big picture that rising rates would start to put some pressure and maybe help ease some of the supply issues we have. I think you said it best, Morgan. We're still at incredibly low rates on a historical basis. So the ability to purchase a home is still really affordable for those that can. I think it's more of a supply issue right now in the marketplace. We need more housing supply generally. Yeah, more housing supply. I mean, nonetheless, the last quarter you were able to buy, it looks like a little bit more than 1,500 homes for $656 million. Are you still able to keep acquiring homes at the pace you would like? We wish we could buy more, truthfully. I mean, demand is just so large for our product in terms of people wanting a leasing lifestyle. What we've started to do is really work with builders. We announced a partnership with Pulte last year. We're going to build almost 8,000 new homes over the next 5 years. So we're starting to see some of that come into our business, but supply is definitely tight. But we're risk-adjusted return investors. We want to make sure that we, are buying properties that will stay in our portfolio for a long period of time and be able to curate an experience for our residents that's second to none. So we'll continue to try to find ways to invest creatively for our shareholders, but most importantly, the customers staying with us longer. They really like the product, and we're trying to drive ancillary services that'll ultimately make that experience that much better.
Dallas, just looking at the acceleration in rents on the leases that your customers are signing. So in the fourth quarter on renewals, 9% rent growth, on new leases, 17.3%. Now, how sustainable is that? Is that just a catch-up move, or can that continue?
Well, trees don't grow to the sky. I mean, let's be clear. We're dealing with a really unique situation. You have a limited amount of supply in the marketplace, and you're seeing that, Carl, in our new lease numbers. And on the renewal side, you want to make sure that you're working with residents and customers, and we have quite a bit of embedded loss to lease in our renewal number. So we view that as potential future growth for the company over time and distance. But we would expect things to normalize. I think back to Morgan's point about rates creeping up, maybe things slowing down a little bit. That I view as just kind of long-term healthy growth, and it will create more of a longer-term healthy environment. You can't have free money and stimulus like this in the economy forever without having consequence. And I think we're seeing that across, whether it's cost of goods sold and you're out trying to buy a new car, or we're seeing it, quite frankly, across all our markets in terms of where rental prices are going.
I wonder, when you think about the consumer, there's been some pieces written lately about consumers who are equity rich in homes that they own, and the potential for HELOCs to unlock some spending power. I wonder how powerful you think that is, or if there'll be too many hot stoves that were touched going back to the housing crisis.
It's a great point. I mean, by and large, most economists would tell you right now, people have a lot more equity in their homes today than they did in 2005 and 6. That's a fact. So I think we're not in the same position in terms of how you look at the borrower. It'd be interesting as rates creep to see how people think about the use of a HELOC or an additional way to create liquidity if your single family home is your personal form of investment. Time will tell. I wouldn't expect it to be too drastic. I think the Fed's doing the right thing by signaling that we're going to start to see rate creep. It should help start to slow things down. But you got to remember, we had trillions of dollars of stimulus come into people's balance sheets. Our resident today is over 5 times on a rent to income ratio. They're only spending 20% of their monthly spend on rent. And that's a pretty powerful metric.